Matthew Bell with insuranceprescription.com. Today I wanted to talk a little bit about retirement annuities, and I've done several videos on annuities, but annuities are just really tricky products to deal with, even conceptually, and so I thought it would be wise for me to just kind of give you a brief survey one more time from a very high level. And so this is going to be very general, and I'm hoping that because of the generality, I'm not going to get stuck in any of the little weeds and any of the finer points of the annuities, and hopefully in that way you'll get a kind of a general survey from a very high level view. So first of all, in general, an annuity helps protect you against living too long, which sounds weird, but it means outliving your money. So you've got a certain retirement nest egg, and the idea being that if you live long enough, your nest egg might not be enough to cover you for that entire period of time. So life insurance protects you against dying too soon, and an annuity protects you against living too long. But we often think of these as retirement products. So think of it this way. An annuity is capable of providing you with money you can hang your hat on, a guaranteed paycheck in your mailbox month after month. So in general, an annuity is going to be a retirement product. You can think of it like a savings vehicle, but not a savings vehicle like your CD. It's a vehicle that's capable of providing you with an ongoing payment for the rest of your life, and that's the real power of an annuity. It can help to ensure that you have enough money to live on in your retirement. Often people will use an annuity to cover their basic expenses. In specific, they can use it as a replacement for Social Security, or they can use it if they're skeptical that Social Security will be around. Now, there are three different types of annuity, and again, without getting too deep into this, I have other videos where I outline the basic differences between these types, but the first type is going to be a fixed annuity. Generally, with a fixed annuity, your principal is going to be guaranteed, so that means no matter what's happening in the market, you don't have to worry about losing the money that you put into the annuity. Usually, that's accomplished in part by giving you a guaranteed rate of return. So there's some kind of a minimal guaranteed interest rate that you're going to get when you have a fixed annuity. If you have the potential for a lot of gain, you also have the potential for a lot of risk. And so where there's a protection against risk, as is with the fixed annuity, you're talking about a very low rate of return. So the modest rate of return is going to protect you against losing your money, but it's not going to make you rich. You pay for the security, in other words, you pay for the lack of risk by sacrificing the potential for return. But when it comes to a retirement product, and when it comes to a product that is designed to guarantee that you have enough money to live on, are you looking for a lot of risk? Are you looking for heavy returns, or are you looking for some kind of a guarantee that you're not going to be in the poorhouse? Now, on the other side of the fence, there are annuities called variable annuities that do offer the promise of a higher return. But once again, they offer that in conjunction with a higher risk of loss, and in fact you can even lose your principal in some of those. So in between a fixed annuity that offers these guarantees and a variable annuity that has the potential for gain but also has the potential for loss are what are called indexed annuities. Sometimes they're referred to as fixed indexed or equity indexed, but they attempt to kind of be a middle of the road. I'm not going to get into the criticisms or the explanations of these further. If you're interested in pursuing that, I do have other videos where I get into that a little bit more. With an annuity, there is a pay-in period where you pay into the annuity, you make contributions, and you establish the annuity, and then there's a payout period where the annuity is paying you that guaranteed paycheck every month for the rest of your life. But during the pay-in period, you have different funding options. And in general, the funding options are you can pay in as a lump sum one time, or you can pay in periodically over the course of a long period of time. If you pay in as a lump sum, it's called a single premium. And if you pay in over the course of time, usually that's referred to as flexible premium or periodic premium. And you have oftentimes a lot of latitude with respect to making contributions. You can make contributions when you feel like it, when you have money, and you cannot make contributions if you don't feel like it or if you need the money for something else. Now, having said that, remember that anytime you opt to not make contributions to a retirement plan, you're potentially sacrificing your long-term financial future or your long-term retirement plan for short-term and immediate situational needs. Now, maybe that's unavoidable, especially in a time like today, where a lot of uncertainty characterizes the market, prices are going up, people are losing their jobs. But you should realize that any decision you make today to not fund your future self, you're putting your retirement plan in a little more jeopardy than it was before. Now, so those are the funding options: single premium or paying it in over a period of time. But there are also payout options. So once you get to the period of time when the annuity is paying you, you've got different options for that as well. Now, one option is to just cash it out and take the money out, but that's not the option I'm really interested in here, because that is a use of an annuity that is a little bit different from the way the annuity is designed to function. An annuity is designed to function to give you a guaranteed paycheck for the rest of your life, and so the question is, how long do you have to wait before you elect that option? And so the answer basically is it can be elected immediately, or it can be elected in a deferred way, that is to say, down the line. So when it's elected immediately, a person puts in a single premium, and then they elect to start their annuity. Usually immediate here means about a month or so, but you put in a lump sum, and then you elect to create what's called a single premium immediate annuity, and the annuity just starts to pay out. Now, for retirement annuities, of course, one huge caveat here is that a person who's contributing to it has to be of retirement age. So I could not set up an immediate retirement annuity and expect it to pay out with no penalties because I'm not 59 and a half. But for people who are, let's say you're 65, you've got a lump sum of money, and you want to contribute it to your annuity and start an immediate payout for yourself, then you can do that. You put the money in, and then within a month you're going to start receiving payments. But the other way of doing it would be on a deferred basis. So I could set up a deferred annuity. I could set up a flexible premium schedule for paying in and set the deferred annuity up so that when I am 59 and a half, my annuity would start paying me some kind of a sum of money, or I could set it up for 66, or set it up for age 72, or I could just leave it open-ended as to when I wanted the annuity to pay out. Now, one other brief factor when it comes to annuities that I will mention here is the tax qualifications. And this is important because there are so many different tax qualified options. So in the main, there are two basic tax qualifications for retirement vehicles. The first is going to be that which corresponds with the traditional individual retirement account or individual retirement annuity, the IRA, and the second is going to be the Roth individual retirement account or the Roth IRA. Now, with an individual retirement account that is traditional, basically you get a tax deduction when you make a contribution, and then the money grows tax deferred, and you pay tax on everything when you go to take the money out. In the case of the Roth, you do not get a tax deduction on contributions. The money grows tax deferred, and then you do not pay tax on the distribution, provided all the rules are followed. But the third type of annuity, besides the IRA and the Roth, is going to be what's called a non-qualified annuity. And in a non-qualified annuity, just like the name suggests, there are no tax qualifications that are specific to retirement products. So there's no perks for that. There are reasons why a person might want to have one in their portfolio, and that is because the traditional IRA and the Roth IRA have restrictions on who can contribute and when you can contribute. So in other words, generally speaking, for retirement contributions for qualified accounts, you have to have earned income, whereas with a non-qualified annuity, you could make contributions to your non-qualified annuity well past the time when you have had any earned income at all. So it can be a valuable resource to have in your portfolio, probably deserves its own special treatment, so I don't want to get into that further. But let me just kind of take stock here and summarize. An annuity is designed to help guarantee that you don't outlive your money. It's for money in retirement, and think of it as being able to provide you with a guarantee of lifetime income. There are several different kinds of annuity depending on how much risk you want to assume, from the fixed annuity offering very low risk to the variable annuity offering high risk, and indexed annuities that fall somewhere in between, or so the story goes. There are different options for paying in. You can pay in with a lump sum. Sometimes people do that with a rollover from a 401k, a 403b, a 457b, or some other employer-sponsored or retirement account. And sometimes people pay into it over the course of time in a flexible, periodic way, just like they were making contributions to their other retirement accounts. Once you elect to start taking payments out, you also have options in terms of how you receive that money. Some of the main options are going to be having to do with the time period between the funding and the payout. So if the funding and the payout are very close together, it might be called an immediate annuity. And if the funding and the time period are further apart, it may be called a deferred annuity. But in any case, I hope that this general overview was of help to you. Many people do find that annuities can be a valuable addition to their overall plan. I would suggest that anybody who wants to have a well-rounded retirement plan should at least consider an annuity. Whether or not it is right for you, though, is going to be dependent heavily on your specific situation, and in order to make a better determination, I would invite you to reach out to somebody who you would consider to be a trusted advisor who's capable of understanding what your situation is and talking through some of these options with you. This video has just been for general, informational, or entertainment purposes only. Please don't construe any of what I said as specific advice. But if you did find something of use, I invite you to like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.